comes as a
and have
byproduct of copper, lead, zinc, and gold. You are going to see some production increases on the gold side, which should give you some increased byproduct silver. But I would suspect not enough to be worried about. I understand your concern perfectly around the incredible margins in the silver business, where the silver industry would increase their production if they could. I just don't see them being able to in the near term. And it's important to recognize, as I say, that less than 20% of primary silver supply comes from silver mines. The intention of silver miners is less important than the intention. This is the first boot camp that we've done that focuses on a region as opposed to a investing technique or copy. The Golden Triangle was chosen because it was a very heavily requested boot camp during the 3-part gold boot camp series that we did. Apparently, gold speculators wanted a boot camp that went into a region where they're heavily invested. The Golden Triangle in northern BC is a good topic for a boot camp for a variety of reasons. First of all, a lot of people are invested up there. And the range of companies that one can invest in goes all the way from Newmont at the top of the peak, the top of the heap, all the way down to sort of penny dreadful juniors. Separately, I have a lot of experience up there. I have been involved in financing exploration in the Golden Triangle since the 70s, and I've been involved in development and production finance since 1984 with the Snip deposit. It's also useful because the geology up there is so profound and so varied. The largest undeveloped gold deposit on the planet, the KSM deposit, is located up there. One of the highest grade open pit mines in the world, Skeena, is being built there. And there are a whole bunch of interesting facets to the geology, to the finance, but in particular to the sociology and politics. The Golden Triangle is a very remote part of British Columbia.
The Golden Triangle stands out because of its extraordinary geological variety. It hosts massive gold-copper porphyries, high-grade epithermal systems, and volcanogenic massive sulfide deposits, all within one remote district. This includes globally significant assets, such as one of the world's largest undeveloped gold deposits and some of the highest-grade open-pit projects currently advancing toward production. Understanding these deposit types isn't about memorizing technical jargon, it's about knowing what a company is actually searching for and whether its exploration strategy makes sense. Without that context, investors are effectively speculating blind.
And it and the surrounding environs are mostly inhabited by Indigenous people. The Canadians call them First Nations. In the context of this topic, if you talk about investing in the Golden Triangle without a discussion of local politics and sociology, in particular First Nations politics and sociology, you miss the point. You don't understand enough to invest. We have a young man, a future mining superstar named Cody Penner, who is himself of Tahltan descent, Tahltans being the predominant tribe in the region. Cody is unique in that he is both sensitive to the community's needs, having grown up in the community, but also has a long career in mining and mining finance. So he has a foot in both camps. So I'm really excited about this. We'll have a great financial overview of the Golden Triangle. We'll have a great geological overview of the triangle. We'll have a sociological and political overview of the triangle. And we'll be able to do topical discussions of 4 or 5 of the companies in the region. Like every other boot camp that we do, remember that we're going to give you more information in 8 hours than you can absorb in 8 hours. We will give you access to the tapes, the recordings, and you're going to need them in order to get out of it what you put into it. Remember, too, that like every educational product sponsored by myself, This comes with a complete money back guarantee. This may be the only investment deal on the planet that comes with a money back guarantee. So we look forward to seeing people, particularly people who are invested in, junior Canadian, either copper or gold or silver stocks. This is also timely, by the way, because one of the participants up there, Dolly Varden, announced last week a proposed merger. So there's just going to be an awful lot to talk about.
Mining in the Golden Triangle cannot be understood through geology alone. The region is remote and deeply connected to First Nations communities, whose participation and consent are essential to project success. Local politics, community relationships, and cultural awareness are not side issues. They are core investment factors. This is why insight from professionals who bridge both worlds matters. When mining expertise is combined with lived community experience, investors gain a clearer picture of which projects can advance responsibly and which may face delays or opposition. Ignoring this dimension often leads to costly misjudgments.
It's critical that speculators have an overview of the geology. It's not necessary that you remember the polysyllabic name of every rock type. That isn't needed. But there's several styles of geology up there. Volcanogenic massive sulfide, the SK deposit, epithermal gold and silver deposits, and then great big gold porphyries and gold copper porphyries. It is important to know something about the basic target that your company is looking for, or else you won't be able to form an opinion as to their ability to find one. So an overview of the geology in the triangle is, I think, very useful. Joe Mazumdar has been exposed to the triangle for at least 25 years. Although he's originally from Australia, it's not as though you imported an Australian geologist who had no experience up there and set him loose. In this particular case, you have a guy who analyzed that, both for Exploration Insights, his current idea, but long before that, as a geological analyst for Canaccord, which was and is the largest securities underwriter focused on that part of that province.
Like every boot camp in this series, the goal is not passive learning but immersion. Participants are intentionally given more information than can be absorbed in real time, supported by full access to recordings for review. The structure reflects real-world investing, complex, layered, and iterative. Financial analysis, geological frameworks, political context, and company-specific case studies are all integrated. This approach allows investors to revisit material as markets evolve. Backed by a full money-back guarantee, the program emphasizes confidence through education rather than hype, an uncommon proposition in speculative investing.
That is a scary-looking chart to me. I don't know anything about charts. I just know, in Canadian parlance, the backside of a hockey stick is just as steep as the front side, but a lot less fun if you're long. I've made, in the very near term, I've made the comment on your show before that one of the most repeatable topics around a gold bull market has been that when the generalist investor begins to come into the precious metal space, that leadership changes from gold to silver. It would appear, Steve, that that's occurred. The silver price is greatly outpacing the gold price. You need to look at that chart and see if the silver market doesn't need a rest. It looks to me like the silver market does need a rest. Now, I'm not a silver buyer. I'm a gold buyer. But I am a silver stock buyer. And that chart gives me a lot of caution. I would say fervor in the streets. I mean, understand that I'm not a trader per se. I construct very, very, very rough models around value. So price matters to me only as it differs from value. And the silver stocks that I had owned as a consequence of my belief in a move in the silver price, I have already sold. My reason to own the stock came and passed, and so I sold the stock. The reasons that I still own the rest of my silver portfolio is because I believe that there are circumstances individual to each company that will increase their value. So, as an example, I own Pan American Silver. Uh, the increase that we've seen in the silver price makes their acquisition of Mag Silver more economic than it would have appeared at the time that they made the acquisition. That was an acquisition that was predicated on $35 silver.
Yeah.
$60 silver rewards them more than $35 silver did. In Pan American Silver, I'm also attracted to it because they have now had 5 or 6 quarters to begin to work their magic on the assets that they acquired from Yamana. And sure enough, they're beginning to get better operational performance at the same time that they're getting higher commodity prices. One could look at my holdings in the more speculative names, Vizsla Silver or Abra Silver. In both cases, I think that there is a lot of exploration upside uh, in the company. In other words, I don't own them purely for leverage to silver. I own them for reasons interior, if you will, to the company. Ironically, in a rip-roaring silver market, there's probably more money to be made on the bullshit juniors that don't actually have silver or the very, very, very inefficient producers. Because as sentiment comes into that market, you can take up a $20 million market cap to a $100 million market cap for no fundamental more specific than a $500,000 financial public relations budget. That's not the way I trade. I'm very much a guy who invests, who buys and sells based on value or perceived value. And there's a lot of value and perceived value remaining in the high quality silver names, despite that parabolic silver chart.
As precious metals cycles mature, leadership often rotates from gold to silver, a pattern seen repeatedly in past bull markets. Recent price action suggests that transition may already be underway. Silver's rapid rise, however, brings both opportunity and caution. Parabolic moves often signal short-term excess, even when long-term fundamentals remain strong. For value-focused investors, price alone is not the signal. Value relative to price is. This distinction explains why some positions are exited while others are retained, based not on metal prices, but on company-specific improvements, acquisitions, and operational execution.
I think it is misplaced, Steve.
Okay.
Because only about 18% of silver supply comes from silver mines. The rest comes from recycling or as a byproduct of mining other materials like gold, copper, lead, and zinc. So to really get a feeling for what silver production looks like over the next 5 years, you have to pay attention to how much copper is going to get mined. And I think irrespective of what we do in the copper industry, we're going to have production declines in copper for the next 5 years, no matter what we do.
Yeah.
Which means that byproduct silver production is going to decline. Remember that as a copper miner, your production cost is effectively the cost of removing silver from the product stream. You have no mining cost because you paid for that in the gold account. The zinc price has been up, but it's still fairly flat. And I don't see any production increases coming in copper or lead or zinc for the next 5 years. In copper, I think it's more likely that we produce less over 5 years rather than more. And that should mean that byproduct silver supplies are lower, not higher, irrespective of the margin available on pure silver mines. When I look too at the silver mines on the horizon that could be brought into production, I don't see many. Certainly the exploration success that, as an example, First Majestic has enjoyed both downhole at San Dimas, but also at Ermitaño, and the prospective joy that Pan American sees at La Colorado. You don't see a new Cannington or a new Juanicipio. You don't see that much silver on the horizon. The two places that you do see silver on the horizon, one would be the Pan American deposit in Guatemala, the name of which escapes me, which appears to have still pretty strong political challenges ahead of it. The second would be another silver deposit within Pan American in Argentina, which is similarly, at least at the state level, politically challenged. So I don't see a lot of impending supply from silver companies. And I don't see near term supply increases from byproduct. That is to say, increases in the next 5 years. Comes as a
And if
byproduct of copper, lead, zinc, and gold. You are going to see some production increases on the gold side, which should give you some increased byproduct silver. But I would suspect not enough to be worried about. I understand your concern perfectly around the incredible margins in the silver business, where the silver industry would increase their production if they could. I just don't see them being able to in the near term. And it's important to recognize, as I say, that less than 20% of primary silver supply comes from silver mines. The intention of silver miners is less important than the intention of recyclers, who are pretty close to maxed out, and gold, copper, lead, and zinc producers.
Silver's long-term outlook is shaped less by investor enthusiasm and more by structural supply limits. Fewer than 1/5 of global silver production comes from primary silver mines. The rest depends on copper, lead, zinc, and gold mining, industries facing declining grades, political challenges, and long development timelines. Recycling is already near capacity, leaving little room for rapid supply growth. Even with higher prices, new production cannot materialize quickly. This imbalance suggests that silver's fundamentals remain supportive, even after sharp rallies, reinforcing the importance of disciplined, value-driven exposure over speculation.